Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 143, and in this episode we are reviewing the performance of the global markets during the third week of 2025, and that is from Monday the 13th to Friday the 17th of January 2025. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where the prices that consumers pay for a select basket of common goods and services rose again in the month of December, but closed out 2024 with some slightly better news on inflation. According to the Bureau of Labor Statistics, the Consumer Price Index increased by a seasonally adjusted 0.4% for the month of December, and over the past 12 months, the rate of inflation came out at 2.9%, which was in line with market expectations. However, excluding food and energy prices, the core consumer price index was a notch lower than the previous month, with the annual rate coming out at 3.2%, which was also slightly better than the forecast rate of 3.3%. Across the pond in the United Kingdom, according to data released by the Office for National Statistics on Wednesday, the rate of inflation in the UK fell to a lower than expected 2.5% in the month of December, with core prices slowing even further. The Consumer Price Index had risen to 2.6% in November, and economists polled by Reuters were expecting the December reading to stay at the same level. Meanwhile, core inflation, which excludes volatile food and energy prices, came in at 3.2% in the 12 months to December, down from 3.5% in November. The UK's inflation rate had hit more than a 3-year low of 1.7% in September, with monthly prices picking up since then on the back of higher fuel costs and services. This inflation data will be food for thought for the Bank of England ahead of its next policy meeting on the 6th of February, at which the central bank is expected to cut its policy rate from 4.75% to 4.5%, despite persistent inflationary pressures and uncertainty over Britain's economic outlook. And staying in Europe, data from the Statistics Office showed that the German economy contracted by 0.2% in 2024, which was the country's second consecutive annual slowdown in economic growth. For your information, Germany's economy had already contracted by 0.3% in 2023. According to the data, this contraction was in line with the economists' expectations, who had projected a contraction of 0.1% in 2024. The contraction in Germany's gross domestic product was mainly attributed to cyclical and structural pressures that hindered stronger economic development. And over to the People's Republic. China's economic activity accelerated more than expected in the final quarter of 2024 as stimulus measures kicked in and made it possible for the government to meet its annual growth target of 5%. China's gross domestic product expanded by 5.4% in the fourth quarter, beating economists' estimates of 5% growth and outpacing the growth rate of 4.6% for the third quarter. That last quarter stimulus helped to lift China's full-year GDP growth to 5% in 2024. And according to China's National Bureau of Statistics, the policy shift in September last year helped the economy to stabilize, but still requires massive and persistent stimulus in order to boost economic momentum and sustain the recovery. On Wall Street this past week, stocks climbed on Friday as the three major averages posted their first weekly gain of the new year. The gains in stocks come after back-to-back reports showed that inflationary pressures were softening and helped to revive a risk-on sentiment and a positive narrative for equities. Big tech stocks were higher for the day, with shares of Tesla popping up by 3%, whilst chip-making giant Nvidia jumped by 3.1%, and Alphabet, which is a holding company for Google, added more than 1%. For the week, the Dow Jones Industrial Average advanced by 3.7% to end the week at 43,487, whilst the S&P 500 gained by 2.9% to close at 5,996, and the Nasdaq Composite climbed by 2.5% to finally settle at 19,630. In the U.S. government bond market, after sharply falling earlier in the week, Treasury yields were flat on Friday as investors assessed the outlook for inflation in the United States. The Consumer Price Index for December was published on Wednesday and showed that core inflation slowed down to 3.2% on an annual basis, which was marginally lower than the forecast rate of 3.3%. At the beginning of the week, the benchmark yield hit its highest levels in about 14 months, and this move was, however, short-lived as Treasury yields plummeted on Wednesday, with the 10-year yield sliding by 13 basis points and the 2-year yield dropping by 10 basis points. On Friday, as the markets came to a close, the yield on the benchmark 10-year Treasury bond was up by 1 basis point at 4.617%, whilst the yield on the policy-sensitive 2-year Treasury note inched up by 4 basis points to level off at 4.278%. And just for your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the foreign exchange market, the dollar held on to gains made against the yen on Friday, but still ended the week on a lower note after a 6-week winning streak as investors await Donald Trump's inauguration and clarity on policy issues for the incoming administration. The dollar has surged in the past few weeks on the back of rising Treasury yields, reflecting expectation that Trump's policies could boost inflation and force the Federal Reserve to hold interest rates higher for even longer. The yen was poised for its strongest weekly performance in over a month on increased expectations that the Bank of Japan will hike its policy rate this coming week, putting the dollar on the back foot. This past week, the Japanese yen climbed more than 1% against the dollar. However, earlier on Friday, the yen touched a one-month high of 154.98 yen versus the US dollar before correcting to settle at 156.16 yen versus the dollar. In the commodity markets, the price of crude oil fell slightly on Friday, but still managed to post a fourth consecutive week of gains as the latest U.S. sanctions on Russia heightened expectations for disruptions in oil supply. The crude oil market has received a boost from the U.S. sanctions on Russian oil producers, combined with expectations of a recovery in demand that is driven by potential interest rate cuts in the United States following the release of the latest data that shows inflation was slowing down. In addition to that, traders are also assessing fresh data from China that shows that the world's top oil importer managed to achieve its ambitious economic growth targets of 5% in 2024. In response, the price of crude oil gained more than 1% for the week as the global benchmark Brent crude came to a close at $80.79 per barrel, whilst the US benchmark, that is West Texas Intermediate crude, settled at $77.88 per barrel. In the precious metals market, the price of gold was pressured by an uptick in the US dollar on Friday, but remained on track for a weekly gain as uncertainty rises around Trump's new administration and policies, plus renewed bets of further rate cuts that helped to lift bullion above $2,700 per ounce. Traders are now pricing in at least 2 rate cuts by the end of the year, with the possibility of more rate cuts if economic data continues to weaken further. Markets now keenly await Trump's inauguration and the implementation of his proposed trade tariffs that are expected to trigger trade wars and ignite a new round of inflation. The price of gold hit a one-month high on a Thursday and was within range of its all-time high of $2,790 that was hit in October 2024. Gold prices have gained about 0.8% so far this week after softer than expected core inflation data in the United States intensified speculation of more than a single rate cut from the Federal Reserve. The price of spot gold eased 0.4% to eventually come to a close at $2,701 per ounce. For your information, gold is often seen as a hedge against inflation as well as political uncertainty and tends to benefit from lower interest rates as it does not provide a regular coupon like a bond. In the cryptocurrency market, the price of Solana's token, which is referred to as SOL, skyrocketed on Friday after a meme coin linked to President-elect Donald Trump was launched on the popular blockchain's network. The moves began late Friday after the launch of a new meme coin was announced on Trump's social media accounts and issued on Solana's blockchain. According to CoinGecko, the new meme coin, referred to as Official Trump, already has a market capitalization of more than $5 billion and is the largest meme coin on the Solana network. This move comes ahead of Trump's inauguration on Monday, which is widely expected to usher in a new era of innovation and productivity in the crypto industry. And just for your information, Excluding stablecoins, Solana is the fourth largest cryptocurrency by market capitalization and was created in 2020 as a faster and cheaper alternative to Ethereum. According to CoinMetrics, the price of Solana has risen about 23% in 2 days to $247 per token. We now change scene to the Kenyan financial markets, and as usual, we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained relatively stable versus the US dollar. And according to data obtained from the Central Bank of Kenya website, the official exchange rate for the dollar was quoted at 129.54 compared to 129.47 that was recorded the previous week. Meanwhile, the sterling pound was priced at 159.22 and the euro was valued at 133.90. And on the regional front, one Kenyan shilling was changing hands for 28.52 Ugandan shillings and 19.42 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.67. The Kenya shilling continues to trade within a very narrow range versus the US dollar, and this price action, where the dollar shilling exchange rate is trading within such a narrow range for a prolonged period of time, is both unrealistic and unsustainable. The central bank has previously stated that it does not have a preferred target range for the dollar shilling rate and only intervenes when there's extreme volatility in the forex market. Based on that premise, the central bank should therefore stay out of the domestic foreign exchange market and let the shilling find its optimum rate through demand and supply. That said, the long-term outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves decreased by $35 million for a total of $9.143 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this cover, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. On diaspora remittances, for the full year 2024, the inflow of remittances reached an all-time high of $4.945 billion, which was an increase of 18% compared to the inflow of $4.19 billion in 2023. Not surprisingly, the inflow of remittances was strongest in December 2024 when Kenyans sent home a record $445 million compared to $423 million in November, which was an increase of 5.2%. The United States remains the largest source of remittances into Kenya, contributing about 51% of the total inflows in 2024. The growth in remittances continues to support Kenya's current account as well as provide stability to the domestic foreign exchange market. In the interbank market, the liquidity situation in the interbank market was sufficient to meet demand and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased by 21 basis points to 11.33% compared to 11.12% the previous week. And in terms of volume, the average value that was traded in the interbank market increased to 34.4 billion shillings, up from 30.9 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 15.1 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 16th of January, and the central bank received bids totaling 18.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance of about 78%, and the results of the auction were as follows. The 91-day rate declined by 2.8 basis points to average out at 9.56%, whilst the 182-day rate was flat for the fourth week in a row at 10.02%, and the 364-day rate dipped by about 3 basis points to settle at 11.30%. In the primary bond market, the auction for the monthly bond issue was held on Wednesday, the 15th of January, and there were two reopened fixed coupon treasury bonds with original maturities of 15 years and 25 years. And during that auction, the central bank received bids totaling about 59 billion shillings against an advertised amount of 30 billion shillings, representing a performance of about 196%. However, the central bank ended up accepting about 48 billion shillings, and the results of the auction were as follows. For the first bond, that is FXD1/2018/15, with 8.3 years left to maturity, the central bank accepted 23.75 billion shillings at a weighted average rate of 14.20%, compared to the bond's coupon rate at 12.65%. For the second bond, that is FXD1/2022/25, with 22.8 years left to maturity, the central bank accepted 24.72 billion shillings at a weighted average rate of 15.68%, compared to the bond's coupon rate at 14.18%. Up next is our topical issue, and this week we're looking at the adoption and use of cryptocurrencies in Kenya. According to the International Monetary Fund, a large number of Kenyan companies are now using cryptocurrencies to settle payments to foreign suppliers, especially when there is a dollar shortage in the domestic forex market or when the Kenya shilling is weakening versus the US dollar. Cryptocurrencies are a digital form of money that is secured by cryptography and exist on a decentralized network using blockchain technology, and unlike fiat currencies, they are not issued or regulated by any central bank or monetary authority. A market survey commissioned by the IMF found extensive use of cryptocurrencies in Kenya, especially in the private sector, which was an indication that the use of digital currencies was much wider than earlier projected. In its report, the IMF revealed that domestic companies are making regular use of stablecoins such as USD Tether as a means of settling payments with foreign suppliers. For your information, stablecoins are a type of cryptocurrency that are backed by a real-world physical asset such as cash. In the case of USD Tether, it is backed by the US dollar and is the world's most popular stablecoin with a total market capitalization of about $138 billion. USD Tether is currently the most popular stablecoin in Kenya and is used by about 49% of Kenyans who are transacting in the crypto market. The IMF survey found that companies are also using stablecoins as a hedge against the weakening shilling, which further drives the use and adoption of cryptocurrencies in the Kenyan economy. The survey estimated that there could be about 730,000 crypto users in Kenya, but the IMF is convinced that the number could be even larger than that stated in the survey. Globally, Kenya is one of the most active crypto markets, and this was confirmed by Chainalysis, which is a blockchain analysis firm that ranks Kenya as number 21 out of 155 countries in its Global Crypto Adoption Index. The International Monetary Fund has always cautioned countries not to ignore digital assets and the threats they pose to their monetary sovereignty and financial markets, urging for regulation to control the fast-growing industry. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, excellence is not about being the best, it's about striving to get better. Think about it. Thank you, and God bless.